but as ever, we've got a lot to get through. Local government funding doesn't seem to, the pace doesn't seem to relent, and I think we're going to get even quicker pace over the summer and into the autumn. So today we're going to start off looking at the business rate baseline reset consultation. I'll start off with that. Then Dan's going to turn to look at the 24-25 accounts, what to look out for, and keep an eye out for some polls there to find out where you are, which will be interesting. Then looking ahead to the spending review and the summer consultation, what to expect there, and also some other updates, various bits of intelligence we picked up about the latest on the funding reforms, and also the select committee earlier this month, which had some interesting nuggets in it that I think will help give an indication about direction of travel for 26-27. So starting off with the consultation on the business rate baseline, I think we already knew it, but it was just good to have that full confirmation there will be a full business rate reset in 26-27. We've pretty much known that was the case, but now we know it for sure. Baselines haven't been reset since 13-14 when the system was first introduced. The consultation paper is available on that link. You've got until the 2nd of June to go back on the consultation response. And you might want to have a look at our briefing note that we issued on the 30th of April. And again, that's available on the website. There will be another consultation paper on, I guess, more strategic issues around the business rate retention. That's coming out in the autumn. And that actually includes some really important issues. So things like tier splits and the potential inclusion of mayoral combined authorities, issues around risk and reward and the levy and safety net, the duration of the reset, whether there'll be how frequent resets will be and whether they'll be full resets or not. And also things such as business rates pooling, and I guess even extending out to the 100% business rate pilots. So some really big issues that are not discussed in this business rate consultation. But overall, the two consultations, I think, suggest that the business rate scheme is here to stay, at least for the foreseeable future. But I think some of these big decisions that they're looking at could change the character of the system. It could potentially concentrate more collection on strategic authorities rather than district councils, more focus on funding strategic projects rather than local funding, and possibly less about pooling and more about the strategic authority level concentration. So let's say some big decisions to be taken, but for us now, we're looking at the reset itself. I think it's worth taking a step back as well and thinking about the business rate retention system, what it's there for. Is it a good thing? The purpose of it is to give authorities a direct financial interest in business rates and in their local economy. But there's been no research about the effect of the rate retention scheme on local authority attitudes, on behaviour, or whether it has encouraged engagement with the local authority. My guess is, anecdotally, that it has improved the way that you connect with your local economies, but there's no evidence that's been collected on that basis. Nothing to support why they're doing it, which I think is a bit of a shame. But outside it's a good thing. From a financial point of view, the additional resources I think have been really welcome for local authorities, even if some authorities would argue that the gains have gone to the wrong place. I think that's fair criticism. The baselines were supposed to have been reset back in 2019 and they haven't been. So there has been that, you could argue, misallocation over the last 6 years. But I think generally for us in local government, if we want fiscal autonomy, we need to start with having greater retention and more control over the taxes we currently have. So business rates, council tax, etc. I think someone's on the. If people could mute their microphones, that would be handy. We've got a bit of background noise coming through. So I think there's probably more support now than there was in the early years of the scheme. I think it's more stable, it's more predictable. The resources coming through it are more significant too. So it's, the financial resources make it worth your time to really engage in the system, but it is still very complex. And that's an important factor. I think the government are trying to set out what their view is about the balance between needs and resources, or needs and incentives. I think this government is possibly like to come out more towards the former, more towards needs than incentives, but it talks about aligning relative need of each authority, etc., etc. So that's kind of where they're likely to put the emphasis, but that doesn't mean to say that they're going to get rid of business rate retention. They're not. That's certainly carrying on. So again, some background about what the numbers look like. This is our chart, which you may be familiar with from our MTFP model, that tracks the amount of retained business rates above baseline in England. That goes back to 2017-18. So you can see there that in 25-26, our forecast based on NNDR1 is that collectively the main 50% scheme will be about £1.5 billion above baseline. And that's been growing year on year since the year or so after the pandemic. But you can see the impact the pandemic had on retained business rate income. You can see there the year before, 1920, it had already almost reached 1.2 billion. It took a big hit in 2021, and it hasn't really fully recovered since then. Clearly, it's gone up since the depths of the pandemic, but it hasn't really hit the levels that you might have expected based on pre-pandemic trends. But nevertheless, it's still a big chunk of money, and a full baseline reset, as you can see there, would capture all the growth up until the end of 25-26. And the small amount of above baseline growth we've got in that chart for 26-27 is entirely based on our forecasts for growth in 26-27 itself. So the full baseline reset captures all the business rate growth that's happened up until the end of 25-26. But it's a large amount of money, but I think it's fair enough that they're looking to reset that and redistribute. And the effect of redistribution has got two elements. One is the amount of your local business rate income that you would lose as a result of the reset, and then how much of the return surplus that you would get back in 26-27. And you can see there that the biggest losers in cash terms is Shire Districts, losing 223 million. Shire Districts have got a very, very relatively large share, I should say, of business rate growth, 40%, and they'll typically have a much smaller share of any redistributed surplus if we've done it on the basis of needs, on the basis of baseline funding level, so they lose quite significantly. The other side of that coin, of course, is that Shire counties would gain fairly significantly, £141 million up on our calculations, a smallest share of retained rates and a largest share of baseline funding level. But you put those two types of authority together in two-tier areas, and you can see that county areas are likely to lose from the resetting of the baseline. We look as metropolitan authorities. Mets generally will gain from the reset. You can see their aggregate terms plus 81 million, but it's important to recognise that not all metropolitan authorities will gain. I think about 2/3 will, but about 1/3 of Mets I think would probably lose, simply because they've got relatively strong business rate growth, and as a result they'll lose from the reset. So it does represent across the country some really big swings, and it's a big part of the redistributed package that the government's proposing for 26-27. So the scope of the consultation, it really is focusing on the mechanics of the reset, and also importantly some indication but no detail about the surplus and how that will be redistributed. Also stating that the treatment of business rate income will be handled in the spending review, which we'll cover later. But some important things that it doesn't cover tier splits. That comes later. It mentions about measuring local authority income pre-reset to include in the overall transition package, but no detail about how that would work. Again, it's shunting questions about risk and reward to the autumn consultations, and nothing about what the levy safety net will look like or the duration of the reset period. Nothing about pooling. A note about local government reorganisation, but again, I think that they're really kind of shunting that or kicking that down the road as well. Same thing with mayoral combined authorities and those wider discussions around the relationship with Devo areas. So are there any issues that you think should have been covered? Well, actually quite a lot, but they're doing that later. So the scope's reasonable for what it's worth. It's looking at the mechanics of the reset. It would have been good to have had some exemplifications and some numbers, but at least I think the scope that it has covered, it's covered very well and given us a good description about what they're proposing to do, even if there are still some quite big gaps. So the approach to resetting baselines, there are some different ways of doing this. The way that it was done in 1314, for those of you who remember, it was a top-down approach. There was that thing called the estimated business rate aggregate, or EBRA. And basically what happened was it was kind of a two-stage top-down process. The government worked out an overall quantum of how much business rates it thought the sector would collect. That was the EBRA. And then distributed or allocated that EBRA, that top-down quantum, between authorities based on your average business rates income in 10, 11 and 11, 12. It was fair approach as far as it went, but it did suffer from some pretty serious drawbacks. And the main one being that it struggled to forecast at the national level some really big factors. So I think it overstated the appeals deduction, which was beneficial to local government, and it stayed there obviously for 12, 13 years. So there's some big problems with that, and that's why when they consulted on how they would reset the baseline in 2018, they were looking at what's called a bottom-up approach. So this is effectively using your latest outturn, which would have been 24, 25 NNDR3, to set each authority's baseline, and then making some assumptions around appeals and bad debts, just to make sure no one could game the system too much. But that approach was, as I said, it was granular, it was specific, it was what we would call a spot reset. And that's what we've currently got in our MTFP model. It effectively takes the latest, in this case, we've forecast 25, 26 outturn, and then use that as the basis for your baseline in 26, 27. A very simple approach, but it won't be possible to do that in 26, 27 because they've got some big changes that are happening at the same time, very unfortunately. So you may have been aware there will be new multipliers for retail, hospitality and leisure properties. The legislation is going through Parliament at the moment. So potentially in 26, 27, we could have 5 multipliers in total, 2 additional multipliers for RHL properties, and then 1 further multiplier for large properties with RVs of more than 500,000 to pay for the cost of reduced multipliers for RHL properties. So the existing 2, the small and standard multipliers, then 2 more for RHL properties, and then a further 1 for very large premises to pay for the reductions in multipliers elsewhere. So a huge amount of change occasioned by that. And then at the same time, pardon me, a regular evaluation. The last one was 2023. The 26 revaluation, it's kind of, we know how they work now and what they look like. And there is an established methodology for adjusting the baselines. We know how that would work, and that's worked fairly well in the past, but I think it would be too complicated to do that methodology alongside doing the new multiplier. So what MHCLG is suggesting is that they are unable to do that bottom-up approach that we would hope they would have done, because it won't be possible to use historic local authority data to predict future levels of income. They won't be able to predict what the impact is of these new tax rate reforms, particularly the new multipliers on your income in the future. So they'll need to come up with a different approach. So the revised approach will actually, I think it's a fair approach. I think they've done a reasonable job at coming up with something in very difficult circumstances, but it will look quite different from what you've got now. So it'll be really a simplified baseline, and it will just be based on gross rates payable, and you will get separate Section 31 grants for pretty much all your reliefs. So apart from those reliefs that are discretionary, you're going to get a Section 31 grant for all those reliefs. So that will cover the cost as at the point at which the baselines are reset, and also any change in cost over the period as well. I think one of the side effects of what they're going to do, though, is that because they will use VOA data as at the 1st of April, is that it'll be a harsher reset, because it'll be based on effectively the outturn for 25, 26, rather than what we'd hoped, which would have been the 24, 25 outturn. So effectively, it captures all the growth that would have happened within 2025, 26. So for those of you who are growing, that's bad news. But otherwise, I think the net effect of all the changes they're proposing is pretty much neutral on your bottom line. That we haven't been able to work it through yet, but I think that's what the outcome would be. And I think what MHCLG have done is they've prioritised accuracy, which is what they've tended to do since 13-14. So there'll be a provisional baseline for 26-27, and then that'll be updated for your actual data for a final baseline in 27-28. I mean, I think that's the preference. That's been their preference since 13-14, and I think that's fair enough because I think we probably prize accuracy, but it has meant an awful lot of complexity. So just to summarize, new business rate baselines based on estimated gross rates, and estimating those gross rates based on the draft valuation list from the VOA as at the 1st of April 2026. Then some deductions for appeals and bad debts with various options outlined in the consultation. And then they'll give you a provisional baseline, business rate baseline for 26-27 based on the estimated impact of the new multipliers using the SCAP codes, and then updating that business rate baseline in 27-28 using either data from the NNDR1, or if that's not sufficient, having a bespoke data collection exercise from billing authorities in the summer of 26. And then updating the business rate baseline in the 27-28 settlement. Section 31 grants paid for all reliefs, so those the discretion reliefs under Section 47, so pretty much all of the reliefs, and then further deductions as you would expect for free ports, enterprise zones, investment zones, renewable energy, broadly in line with the current arrangements, but with some adjustments to compensate to cope with the new multipliers, etc. So just summarising that baseline, it's a similar approach to the revaluation adjustment. So you get a provisional in the 26-27 settlement, and then a final adjustment to business rate baseline, and therefore to tariffs and top-ups in 27-28. I think our concern really is about whether there will be material variances between the provisional and the final. When this approach is being used for revaluation, the variances have been pretty small, but there's a lot more going on here, and I think the potential for quite big variances is there. So you could find that there's some quite big movements between 26-27 and 27-28. So I think the way they use those SCAT codes, those special category codes, to create your provisional baseline will be really quite important. So treatment of business rate reliefs. So this is a really big change, to be honest. Roughly, reliefs are worth about 20% of gross rates payable. So some pretty chunky payments are going to be made for Section 31 grant payments in respect of reliefs, particularly for charitable relief rather, and for unoccupied property relief. Some big amounts there, 6%, charitable relief 6% of gross rates, unoccupied relief or empty property relief worth about 3% of gross rates payable. And I think it's fair enough. The MHCLG have kind of recognised that there's too much risk involved in trying to estimate the reliefs. They could get them quite significantly wrong. They won't know how the new multipliers will actually affect the level of reliefs, and that'd be really difficult to put that in as a deduction in the baseline. So I think it's a reasonable solution, although it does change the character of the way that the system works. I think the main problem for me is that it will reduce the exposure that the authorities have got to the level of charitable relief or the level of empty property relief in their areas, which is kind of part of the purpose of the system. But obviously, I'm sure many of you will be welcoming that because it reduces risk, it helps with financial planning, and it should increase yield as well, because any increase in RV that you generate, you'll get the full increase in gross rates from that. You won't have any deductions if some of that increase in rateable value attracts a charitable relief or other types of relief. That'll be fully funded. So that's in those terms, it's a good thing. Appeals is always a problem. It's been difficult to forecast. Previously, they've used a bottom-up approach, or that was the intention that they would use here, and that was kind of how we had assumed they would do that. That's what they've done with the revaluation as well. They've effectively said, what's your closing balance for appeals on Part 5 of NNDR3, and then use that to infer what the level of appeals is within your area. It was subject to some level of gaming, but it was pretty difficult to do, or you had to be fairly bold in order to do it. MHCLG views that circumstances are different now, because the appeals, the adjustment for the appeals that they're going to have to make coincides with a revaluation, and reasonably enough, saying no authority will be able to make an informed estimate about its future level of appeals. Fair enough. So the proposal is to have a top-down methodology, estimate the quantum of future appeals That's nothing new. That's something the VOA does every revaluation. In 2023, they estimated the future losses from appeals would be about 3.4% of gross rates. But then there's a choice about whether you allocate that quantum based on just on rateable values or using a range of other factors. So that top-down approach was effectively used in 13-14, and that quantum of estimated appeals was just distributed using rateable value. I'm not sure that was particularly a good approach, because the rates of, or the levels of appeals are very different in different parts of the country, and an average deduction didn't reflect that huge variation. But they haven't proposed a specific alternative, and I think that's because they don't really have one as yet. It's not really clear what does drive the level of future appeals. It could be about the number or type of hereditaments in an area. It could be about the revaluation change. We don't know yet, and we need to find out from MHCLG what they think or what the data tells them. If we do look at, say, the appeals provision in Part 5 that you've got compared to the change in RV at the last revaluation, you can see there's not a particularly strong link. There is a little bit of a link. The R squared 0.14, so there is something of a link, but it's not particularly strong. So what is the most suitable driver to allocate that appeals quantum? What other factors should be used? And also, is the underlying data that you've got in NDR3, is it reliable? Is it something that you can actually use to determine what those factors should be? So I think there does need to be another set of factors. They can't just use rateable value, but they do need to tell us more about what process they're going to use or what formula they're going to use. I think appeals tend to be a bit higher in urban areas, tend to be a bit higher in places with office accommodation and with central locations, but I think that's more anecdotal than database, so we need to see more from MHCLG on that. Then the second deduction they'll need to make after appeals is a deduction for bad debts or non-collection. And again, the consultation talks about having a top-down or bottom-up approach. I think it's fair to say MHCLG is fairly open-minded about this, but I think the problem with making a deduction for bad debts is just the data is very volatile. Big differences from year to year from authority, from NNDR1 to NNDR3, and between different types of authority. So it's going to be quite difficult to come up with a process for doing this. My view is that the bottom-up approach is almost certainly too volatile, too varied, too unreliable. The top-down approach, I think if they did that, they would have to do a flat percentage deduction, either 0.5 or 0.6% of gross rates payable. So I think if you look at your data and think that you're losing more than, say, 0.5 or 0.6% of your collection to bad debts, I think that's something to respond to government to say, well, actually, we think our deduction from our baseline should be higher than that, and you need to take into account our local factors. Equally, if you think you're losing less than 0.5%, possibly just say the top-down average approach is fine. But that is a distributional issue, really. And if you look at different parts of the country, we look at those two different approaches that MHCLG are suggesting, you can see that option 2, which was using those two elements from the NNDR3, was slightly more consistency region to region, about 0.5% average across the country. I think you could possibly say that London, the Northwest and the Northeast have got slightly higher levels of non-collection, but I don't know how solid that data is. Lower in the Southeast, lower in Yorkshire and the Humber and the East of England, but I don't know how convincing that data is. So we need to get MHCLG to try and untangle those drivers. Otherwise, an average deduction is the only realistic option. Cost of collection. Currently, it was just deducted from the national baseline back in 13-14, and then or billing authorities deduct your own allocations based on a formula from your non-domestic rating income. But the amount that's deducted has remained static at 84 million. And MHCLG recognised that they need to work out what the real cost is of the cost of collection. So looking for data from yourselves to see if they can help on that. They don't feel they've got a granular, robust data source to use. So I think they're looking for contributions from authorities to help on that. Then with designated areas, as we all know, it's a really complicated element within the business rate system. And it's usually the bit that's the most complicated part of the revaluation adjustment. But the amounts that are being deducted now are growing quite substantially. So they need to come up with a reasonable approach. So they need to have an amount. The baselines that DAs have aren't reset. They're set in regulations. They're adjusted for revaluation, but they don't move. They're not reset for 25 years. But the amount that needs to be deducted from local authorities' baselines in respect to the DAs does need to be updated. But there are various problems with the methodology. For me, designated areas operate on the basis of collectible rates, i.e. net rates, whereas the new baselines for authorities are going to be based on gross rates payable. The VOA data that's going to be used for the local authority baselines doesn't distinguish between DA and main scheme hereditament, so some adjustments will need to be made there, and some DAs are still below their baseline. So I think what MHCLG is going to have to do here is a fairly manual process to work out what the deductions need to be from gross rates payable for from the local authority baselines. So work out what the GRP is for each DA, minus an accounting adjustment, minus the DA baseline, and then deduct that from local authority baselines. But then there are further problems about how do you deal with reliefs within designated areas? Do you pay them from Section 31 grants in the same way as for the main scheme, or do you allow DAs to continue without any change? And also, what's the impact of the new multipliers on DAs? We just don't know. I think some of these problems are quite intractable, really, and I think in the end they'll just need to come up with a practical approach, but really making sure that they deal with you as authorities who've got DAs and making sure that works properly. There'll be a further deduction for renewable energy. So I think the headline here for me really is that MHCLG have committed to continue with deductions for renewable energy. So for some authorities, this is a really big deal. Some really big renewable energy deductions. North Yorkshire Council, 16.4 million. So really big amounts, and for those to be continuing, I think is quite a good. It's a very good news story for those authorities. Deductions from local authority baselines for these schemes are much simpler. Few, if any, reliefs and no baselines to complicate the process. So just before I hand over to Dan, a few quick points about the implications of the proposed baseline reset. I think the key thing for me is the system will look quite different. So business rate baselines will be a lot higher because they're based on gross rates payable rather than on a form of net rates. I think as well, the baselines for 26, 27 could be very provisional indeed. A lot depends on the quality of the data from the SCAP codes. A lot depends on the quality of the deductions that MHCLG are making from your baselines as well. And quite a lot of that stuff, MHCLG doesn't have good data. So there could be some quite big movements between 26, 27 and 27, 28. Without any adjustments to BFLs, and they're saying there won't be adjustments to BFLs, there'll be quite a big net tariff. So for all authorities, you'll either have a higher tariff or a lower top up. And for many of you, I think it'll mean that you'll end up moving from top up to tariff. Authorities will not have to bear the cost and the risk of increasing reliefs. That would be, I think, quite good for many of you that have got growing levels of charitable relief. So that'll make for easier forecasting, make for less risk and less erosion of revenues as well. And the final thing there is that baselines will be based on a later point in time than we had originally expected. So it'll shift to the 1st of April 2026, i.e. the point at which the VOA provide data on rateable values, rather than what we had expected until a couple of months ago, the 31st of March to do 2025, i.e. 24-25 and NDR3. I've just scooped through a few of these issues. There's quite a lot to cover, but I want to hand over to Dan. So I think the key thing here is that, as we've already mentioned, tariffs increasing, top-ups reducing, and MHCLG indicating that they will continue with baseline funding levels indexed rather than adjusted. So what that means is if there are any change in SFA or any amounts rolled into SFA as part of the fair funding review, that will result in a change in revenue support grants, and RSG effectively is taking all the strain for any changes in SFA. And our initial modelling indicates that the net tariff for the 50% scheme alone could increase from roughly 0 to about 3.8 billion. So a much bigger net, well, a big net tariff, where in the past we've been used to things being roughly balanced. And I think the impact of that is that it'll see more authorities subject to the levy, and I think it also will make business rate pools less viable because more of them will have a net tariff. A whole range of things as well about negative RSG, which kind of follow on from the fact that you're going to have much higher levels of or much changes to SFA, and some SFA for some authorities going negative without any change in baseline funding level. That will result in negative RSG and potentially also negative SFA. I haven't really got time to go through this, but I know I've had a few emails on this subject, so I thought I'd put a slide in there. Feel free to come back to me on that. We'll discuss that in more detail if that's of interest to you. Section 31 grants for cap compensation. With the baseline reset, there's no requirement to pay Section 31 grants for cap compensation because the baseline reset effectively funds you at the level of income that you've got. But the payments for those are very significant, 2.7 billion within core spending power, with further payments in respect of above baseline growth. So we're assuming that all that funding stays within local government and then is redistributed based on baseline funding level. But there are other options there, and I think this is something that we'll expect government to come back on later in the year, but some quite important issues there that are quite distributional. But we're assuming that that funding remains within the system. Business rate pools and pilots. Our view is that business rate pools will continue to be available in 26-27, and that some authorities will still want to use them because you want to maximise your retained rates. But I think they'll be much less viable after the reset. First of all, there'll be much less growth in the early years, so any pools will be much more marginal. If we take our minds back to when they first started back in, what's it, 2014 or so, you know, that was a big part of the calculation. Would you have any growth to share? The top-ups and tariffs will change, so that pools will tend to be much more tariff pools, much harder to make viable. And also the creation of more unitaries means that there's just less demand for them. It's two-tier areas that really need business rate pools. And I think the focus might well be on enhanced retention in DEVO areas and using 100% pilots in those areas rather than using pools in two-tier areas. Reorganisation has big issues. I think we've probably spent far too much time on LGR recently, so let's skip over that. And that's probably a bit too much as well to look at here. One final thing about the business rate quantum and the redistribution of the surplus. There are some strong indications this will be the case. We've got this in our modelling already. We're assuming the 1.5 billion from the baseline reset plus the 2.7 billion from the cap compensation is redistributed back to local government based on needs, and that looks like the strong candidate for what will actually happen. But it's a big decision for ministers today to take, and you can explore how that works within our MTFP model as well. So Dan, I will hand over to you.
Thanks, Adrian. Morning, everybody. So I just want to have a quick look forward at the 24-25 accounts that I'm sure you're all busily working up at the moment. And in order to do so, we'll look back at 23-24 and see if there's any trends there that we think might continue or halt or whatever. If you move on one slide, Adrian. So we'll look at losing 23-24 accounts. We'll have a look at the trends. I want to look at the accounts audit backlog, net worth, effectively the bottom of your balance sheet. Usable revenue reserves often used as the main measure, isn't it? It's not the only measure, but it's often the main one, because when you run out of usable revenue reserves, you're potentially in a 114 position. To get school grants deficits, often in the news. And then we'll have a look at debt as well. But I think debt's, again, often in the news, but misreported and misconstrued often. So I want to have a look at the different aspects of debt. So if we move into the first one of those, which should be accounts and audit backlog. So we're now at a point where the accounts backlog has virtually disappeared. It's just Birmingham that still haven't released accounts for 22-23 or 23-24, and then a further 5 authorities that still haven't released their accounts for 23-24. Of those 5, the exception of Birmingham, so the other 5, it looks like they're imminent. So it looks like they're caught up, whereas Birmingham seems to be in a perpetual state of flux and delay. The audit backlog has also all but disappeared, but it's changed, hasn't it? It's no longer a backlog. It's now a big lump, about 60%, 55 to 60% of disclaimed opinions. So there's all that work to do to regain the assurance that feels that that'll fall upon you guys as well as your auditors. But generally, the old backlog, which we used to make a lot about, has disappeared. It's moved into a different space. If we move on one, and if you can try and launch the poll, Adrian, don't know if we'll be successful with this. Adrian and I are both a bit rubbish with Teams. I've tried to do some polls here. Oh, excellent. So your name's not recorded. It'd be really interesting to see when everybody is anticipating releasing their accounts. They've done this previously with a smaller group, and as I see there, yeah, just 3 that look like they're going to be 4 going to be late. 17% then on 31st of May. That'll be really interesting, because that will allow us to do some preliminary work on, if I extrapolate that, 17% is, it's about 40 councils. So we'll have some first looks at what we're about to see in mid-June, based upon if those accounts do get released on the 31st of May, or perhaps in the first week in June as well. We'll be able to come back maybe next month and give you a first look at what's happening with the accounts, which should be interesting. But what you can see there is the accounts deadline, the accounts backlog has again all but disappeared. So there's not going to be many of you that add to that backlog, because most of you will have published by 30th of June. Whether your auditors will be able to give you an unmodified audit by their deadline, well, that's another question, and perhaps one for another time. If we move on one slide then. So what I've done here is imagine for a moment that the government went really mad with devolution and just created one local authority for England. This is what its balance sheet would look like, but probably more realistically, let's call it the whole of local government accounts. So I've reconstructed the balance sheet, which is all but the 6 authorities that haven't published, and what it looks like. And you can see there that there's quite a few things going on. And if you move on one slide, I'll just highlight some of those. So last year, general fund usable revenue reserves reduced. A lot more got pushed into general fund balances. I guess that's because 151s were thinking, well, there's lots of risks around. We need to make sure the general fund balance is at an appropriate level. But that seemingly was at the cost of earmarked reserves, which were reducing at quite a significant rate. And that's the second year in a row that they've done so. It might actually be the third. I think there was a small reduction the year prior to that, but really large reduction. So the question for 24-25 is, will that trend continue? And if it does, I suspect it'll put a lot of authorities in jeopardy of requiring financial support or 114. HRA reserves are falling at an even greater rate. We're going to do a lot more work on HRA this year, both on revenue and capital. It seems to me if you've got HRA, generally that HRA is not looking too healthy at all. A lot of that's down to caps rent increases, I suspect. But even looking at some of the on the unusable reserves, which tend to be forgotten a little bit, collection fund surpluses, the collection fund adjustment account start to reduce. Now that's a whole host of things. It might be to do with business rates and how we predict our business rates, but it could also be cost of living start to find its way through, collection rates coming down perhaps, and there not being as much money to put forward to future years in terms of collection fund surpluses. So another potential pressure as that comes down. So it'll be interesting to see where that goes. And then DSG deficits, which are just heading upwards unchecked really, but we'll go into more information on that in a minute. If we move on to a bit more detail on usable revenue reserves. So what I've got here is some work I've been doing around reorganisation. So I've split the unitaries here into the years in which they were formed. So lots of unitaries were formed back in the 90s when the first unitaries were formed. But 8 or 9 were formed in 2009. That's your Cornwalls, your Durhams, your Wiltshires, Shropshires, Northumberlands, etc. And then quite a few more recently. So your North Yorkshires, Somersets, Buckinghamshires, Dorsets, Northamptonshires. And what's interesting actually is those unitaries that were formed quite recently seem to be doing less well. Now, whether it's because they were formed in the middle of massive funding cuts, or whether an inflation and all the other pressures that are going on, it's made it more difficult for them, I don't know. But it's interesting to see that those that have been formed for longer tend to be much more stable. And then when we look at what I've done here, the green bar is 2-tier areas. So it's aggregated together counties and districts, because they will be, won't they, in a few years' time. And what you're seeing here is reasonable levels of usable revenue reserves and not great depletions at the moment. But when they become new unitaries, I don't know whether becoming a new unitary in itself and all those additional costs has a heavy burden on reserves. The recent unitaries would seem to indicate that that might be the case. But actually, two-tier areas in total are quite resilient. That tends to be because the counties haven't done so bad. Counties tend to have higher tax bases. They haven't done as bad as others over the last few years. But districts, still half the districts are increasing their reserves. But that's probably pretty much down to business rates and the retention of business rates growth that, as Adrian's just been talking about, it's about to be reset. And I think Ashley put in the chat that as soon as that happens, his authority might go bust. So there's a lot of pressures on here. So again, in 24-25, it'll be interesting to see where they are. If you go on to the next slide, I think it just breaks those. So that breaks those up into individual districts. Again, the green bars are 2-tier areas. So at upper tier, which we're all going to be before too long, aren't we? There's just a handful, 5 or 6 authorities where reserves went up. They created pretty much last year. If you go back into the chat and you go, if you can go to the chat and go up to the top, you'll see a poll that I put in earlier, right at the top of the chat, and you could submit a vote. It's anonymous, this, so there's no recording of the names. But if you're minded to, I've asked the question there: will your usable reserves increase or decrease? If you can see, it's a live poll in the chat, so feel free to tell us what's going to happen there. If you want to move on, Adrian, I think it is actually at the moment 100% increase in reserves, so that's interesting. If you move on, another one, sorry, Adrian. So that's just that question. Oh, we've now got it's a very small number of you've answered this, but there's quite a few increases in there. Now it'll be interesting to see if they're districts or whether usable reserves are starting to flatline a little bit more. The decreases aren't so bad. Yeah, 10 people answered, it's 50-50. So yeah, feel free to add to that if you will. So if you move on to another one, sorry, Adrian, let's get into dedicated school grants. I mean, this is something that looks really grim. Deficits in dedicated school grants are just on the up. Even those that are still in surplus are tending to see those surpluses reduce. I've heard it said that we reckon next year, 24, we're just below 2 billion at the moment. By next year, that'll be 3 billion. Be interesting to see that. I'm not convinced it'll be 3 billion, but I wouldn't be surprised if it was. And I think is it Alats or somebody else has said 8 billion. If nothing happens, there could be as high as 8 billion by 29-30. If you move on, Adrian. And again, DSG deficits, it's really interesting to see here. They're really big at recently formed unitaries, those in 2009 and those that are more recently formed, which tend to be bigger county areas. And again, if you look in 2-tier, which for DSG deficits is just the counties in actual fact, you'll see there's some fairly hefty deficits there. So county areas, shire areas, are not doing well in terms of DSG deficits. And I suspect that's something that will continue to be the case. It really points to newly formed unitaries not being in the best of financial health, which isn't great, a great message ahead of the next 3 or 4 years when there will be significantly more newly formed unitaries. If we move on now, let's skip that question. I couldn't get the poll to work. Into capital health. So here we're looking at the need to borrow, but also the composition of that borrowing. And I keep saying that there was a lot made. There's a lot made in the local elections. Those who had them, that the debt's massive. Well, if it is, it always has been. Debt need to borrow went up by 4% last year. So in real terms, in a year when CSP went up by 10% and inflation was pretty much 10% around 23, 24, debt's actually come down. So I'm not convinced it's debt itself is the problem, although there might be lots of pent-up demand for capital expenditure that has been, hasn't been fulfilled in the last few years. So it might become a problem. But for now, it feels to me like the problem is much more one about how that debt's made up. And you'll see there that I've shown how it's financed, whether from short or long-term borrowing or from internal borrowing. And what we're seeing is short-term borrowing go up massively, and put that down to falling resources, meaning that internal borrowing isn't sustained, and internal borrowing in some areas is really coming down. If you look at the EFS authorities, about 30 that have got EFS support, bizarrely their short-term borrowing's coming down, their long-term borrowing's going up massively, and their internal borrowing's coming down. They just don't have the cash resources with which to sustain their need to borrow, so they're already in trouble having to go out to the market and pay interest rates. And if we look at the next slide, it gives you an idea of what those interest rates are looking at. So this is the PWLB end of year borrowing accounts split up into when borrowing matures. And you can see up to the end, to 31st of March 25, the average loan rate was about 3.6, and there's £77 billion in England of PWLB loans. There was 11 billion added to that, but an average rate of 4.81. And what you can see there as well is there's lots of short-term borrowing going on. So that's costing a lot more at the moment. And although we've seen 3 drops in 24-25 interest rates, if we move on one slide, Adrian, I think what we're seeing is in 23-24, there was a lot more interest receivable because it was a year of massive hikes in interest rates. Interest receivable went up. Interest payable also went up, and that's partly because there's a little bit more borrowing, but it's also partly that the average rate of borrowing was going up because borrowing was becoming more expensive. But in 24-25, we've had 3 cuts. So I would expect interest receivable to drop in 24-25, partly because of 3 cuts during the year, although they're fairly modest cuts of 0.25. But actually, it's also, if there's a lot less cash swilling around, there's resources continue to deplete, or DSG deficits continue to go up, less around, therefore that should go down. But I think interest payable will continue to go up because there is more borrowing and borrowing rates are still reasonably high. So if you look at net interest, that I think will become a problem for authorities. So I don't see the need to borrow itself isn't changing markedly, but the makeup of that borrowing between internal and external borrowing at a time of volatility in interest rates, or relative volatility, to me is the bigger problem here. And if we move on one more, so just some predictions really. I think, well, as you've shown in the survey, pretty much all of you are going to meet the deadlines this year. Net assets, net reserves, net worth, I think is going to reduce a little bit, certainly as a proportion of CSP. I'm less sure now because looking 26 responses, 14 out of 26 will see reserves decrease, and 12 will see them increase. So maybe usable revenue reserves reductions are starting to halt. It'll be really interesting. But I'm pretty sure DSG deficits will go up. And I'm not sure capital financing requirement will increase significantly. It might do more in London, it has done in the last couple of years. But I think the problem will be one of not being able to sustain internal borrowing and more exposure to external short-term borrowing and the market rates. But really helpful. Thank you for those of you who filled out the polls. I think there's going to be enough accounts come the end of May for us to do a session where I look at all of those predictions, tell you what's actually happening, and then in July we'll definitely do a much bigger session where we'll look at the 95% of accounts that are released and what it means for financial health. And that's me. Thanks very much, Adrian. Back to you.
Cheers, Dan. Last few slides now before we finish, just sort of looking ahead a little bit. So starting off with the spending review, 11th of June. But just to be clear, we're not expecting any local authority specific allocations until there's provisional settlement in December. But what we should get is confirmation of the departmental expenditure limits, the DELs, some indication about the quantum of funding for social care. And I think that's quite an important, those two things are really important in terms of the assumptions we put in the model. At the moment, we're expecting the DELs to be fairly flat in terms of what comes through to local government, flat in cash terms. But we are expecting some funding to come through for social care. Our model's got £600 million of increase per year for social care grants. Let's see what comes in the spending review. I think we should get some indication about council tax thresholds. We don't always in the spending review, but you know, that's one thing that really we'll look out for. And then also about the business rates multipliers and any funding streams going on within business rates. There could be some quite odd numbers coming through there when you think that they're going to be funding through Section 31 grants some of the reliefs. Potentially some specific announcements on things like transitional support and damping, and also around some of the expectations around the funding within the business rate retention scheme, i.e. the use of the reset surplus. I think they're probably less likely. We might get an indication, but I think, again, that's something that is probably going to get hidden within the departmental expenditure limits that we only really find out about in the provisional settlement. So we'll do our full briefings straight after the spending review and a webinar like this a day or two afterwards, so we can discuss it in quite some detail. Then the summer funding consultation that we've been promised, and again, there've been quite a lot of confirmation that we are expecting it in June, even in the select committee last week. Nico Heslop saying it will be in June. Certainly it'll be after the spending review. Is it really going to be published in late June? If it is, great, fantastic. The earlier the better. But my guess would be it'll slip into July. Let's see. But we're just not sure what the format will be, what it will cover, whether there'll be any exemplifications. Authorities have been told that they'll be able to use the consultation to work out what they're going to get in the provisional settlement. But I think realistically, if there are no exemplifications in that consultation, I think that'll be really, really difficult. And different views from different people about whether there will be exemplifications. We've not had confirmation that that will be the case. MHCLG have got a recent habit of trying to explain in narrative form what a formula looks like, but there's no substitute for numbers, as we know. That's what we want to see. And a huge amount has been loaded onto that summer consultation. There's a huge range of issues that need to be consulted on. There's a huge burden, a huge amount of expectation on it, and I think it's going to really struggle to do that. So we'll get what we can out of that summer consultation, but I suspect we'll be still trying to fill a lot of the gaps in and still waiting for more consultations and more developments during the autumn. You may have seen there was a select committee with the Minister for Local Government and also the Director of Local Government Finance facing questions from MPs. I'll just pull out a few of the key things that I think are important there. One is that the government's seeing their role as being an equaliser in the system, which suggests that council tax equalisation will be an important part of what they want to do and what they want to show they've equalised levels of council tax within the system. When talking about needs and resources, it's interesting the things that the Minister was really highlighting. It was things like deprivation, the cost of rural services delivery, daytime population booms in large cities. They're things that we might see in the foundation formula. I would definitely expect to see high levels of weighting for deprivation. It looks like they're going to bring back daytime population or non-resident population into that foundation formula, but I think it's more likely that we'll see a density indicator rather than anything to do with sparsity or rurality. So it's odd that the minister keeps on referring to rural costs when I'm pretty sure he's not going to put an indicator in for rural costs. He mentioned rural 6 times and didn't mention urban or density on one occasion. So it's interesting how these things get presented, but I wouldn't expect to see any kind of rurality or sparsity indicator in the foundation formula. He talked about a huge program of local reorganisation, which we're all fully aware of, but kind of indicated that they would be taking into account the level of savings from those new unitaries by the 3rd year of the multi-year settlement. Wasn't very clear, but that's my interpretation of what he said. If that's the case, and it's very, very dangerous to do that, and very dangerous for the sector to allow the government to think that that's a viable proposition. I think that's very, very risky. A lot of emphasis that deprivation is a significant contributor to demand, and also talking about that being coupled with low tax bases. So really looking at what happened in the recovery grant and repeating that kind of process within the fair funding review. Effectively, high levels of deprivation weighting I'd expect within the needs side of the SFA, and then full or close to full equalisation of council tax. Also talking about housing costs, daytime populations, transport costs. That would be good news for many London boroughs, which I think are facing potentially quite big cuts in funding. But if those are the kinds of things that ministers are focusing on, that's better news for inner London. So they're the key things. It's a really interesting read if you want to go back and look at that select committee transcript. Later on funding reforms, just very briefly. Council tax equalisation, I think that the indications from officials is that they will do the higher level of equalisation, something close to 100% is what they're indicating. Whether that's viable and feasible or not is a different matter, but that's certainly where ministers and officials are, to have the higher levels of council tax equalisation. And I think as well, bringing back in things like urban-based indicators within the foundation formula, so things like density, things like non-resident population, and very, very unlikely to have things like sparsity or rurality in there. That just seems to be where they are. And then I think a lot of the discussion as well is about the new formulas for children's and the new formula for adult social care. It looks pretty certain they'll use the new children's formula, but I think there's quite a fight on about whether they use the University of Kent's formula for adult social care. So that's where the debate has been over the last few weeks and months. Very, very quickly, right at the end here, this is our, you'll know in the MTFP model, you can select a range of different funding reform scenarios, and this is the summary of them. I made a correction to the model I originally sent out, so use the revised default formula now, which is kind of what we did think was the most likely at the point at which we put it out. But you'll see there that we've got partial equalisation, 85% of council tax income. I just don't think that's realistic in many ways now, and I would be looking, from your point of view, at some of the options that have got 100% equalisation. So looking at, look at what would happen to your authority's share of funding if you select the Sagoma or the Met's best case or the Inner London best case. That will shift money around in a different way. But my advice generally is to just use those different scenarios to get a view about what the range of potential outcomes is for your authority. And the final slide, just reiterating that if you go into the systems assumptions tab, you can select those different scenarios to see what you think what the potential range of outcomes might be for your authority. So you've got the revised default, which is kind of what we thought was the most likely, but you could also select, for instance, the ones highlighted there, the Met scenario. That's the one that's the best case for Mets. The county one is the one that's the best case for counties, and Inner London, the best case for Inner London, etc. So you can look at how those different sets of scenarios come together for your authority. And it's really about trying to get an idea about the range and the uncertainty for your authority. If you think you're going to lose from the funding reforms, or you just want to see what the impact is, you can set a damping floor. The default is 5% of total resources. So in other words, you won't lose more than 5% of total resources in any one year, but you can change that to make it more or less beneficial. And then select a methodology for distributing the specific grants, different options there as well. And finally, we'll update all this following the spending review on the 11th of June, and then following the summer consultation, hopefully later that month. So that is all from Dan and from me. If you can't stay any longer, thanks for coming along, and we'll see you soon. If you do have any more time, we'll open the floor for discussion, for questions, any thoughts, and also if you wanted to go back and look at any slides that we had to skate over quickly, feel free to ask us to go back and look at those in a bit more detail as well. So Dan, the polls were good.
Yeah, well, I'll have to figure out how to put polls up better. Sorry about that, guys, but one was an instant poll, one was one we created earlier, Adrian, wasn't it? So interesting. We'll see quite a bit out in May, not a massive amount, but 14% will be enough to have a look at the first trends there for 24-25. And I am slightly surprised, interested with the number of you that said your reserves will increase. So I wonder though, were they mainly districts with the last year of business rates gain, or are there any of you there from upper tier authorities that are saying that your reserves have increased when perhaps they've fallen in the last 2 years? That'd be interesting. Interesting to know. So the latest results on that, 17 out of 30 thinks their reserves will decrease and 13 increase. Anybody willing to go further and give a bit more specificity of that, or is that something we'll wait till May and June to see?
Oh, some more coming through. Oh, we've got one more coming through. It's 50-50, isn't it, Dan? Kind of, not quite. I think that was, yeah.
I've got
plurality going to reduce.
Another reduction. So it'd be interesting. But it does. I don't think local government can take another couple of years, certainly upper tier authorities, of the same length, sort of magnitude of reductions, and it'll be interesting because I've often said I think there'll be 10 authorities at least that will have DSG deficits larger than their usable revenue reserves. It's currently 3 from 23-24, but I'm guessing most of you with DSG deficits are going to see them increase again if the ALAP's work is correct.
I think the data you've got down on local authority accounts will be interesting to put alongside the funding reforms, and I think one of the big constraints there's going to be on the level of change that's possible from the funding reforms is financial sustainability. It's going to be how much of a loss of funding can any council actually absorb. If people are already expecting reserves to be going down this past financial year before any big changes in funding, you'd imagine that would be. I mean, it might still be 50-50 in 26-27. It just could be the other way around.
Yeah, but it's interesting because districts aren't. You usually don't see districts in this discussion as much because reserves have gone up a little bit in districts. But they've gone up in more than they've come down. But I think the reset. I think Ashley put in the chat. The reset will just wipe them out in one go if there isn't some decent transitional relief. So I think districts now will next year come into the reckoning because of their reliance, or some districts' reliance on business rates gain. It's just going to be swept aside. So that will be interesting to see. Yeah,
and I think for some districts, I mean, as bad as some parts of London could really suffer from the funding reforms, but I think it's districts that will take the hardest hit, and I think Ashley's gone off the call now, but I think Ashley's probably saying something that's representative for for most districts, not all, but most districts. That business rate reset is going to make a big difference to the total resources available. Big, and I can't. From what ministers are saying, it looks like they're going to have transitional support for maybe 3 years, but how viable does that make how viable
Yeah,
does that
exactly.
make authorities' finances?
And that in turn makes the new unitaries, the reorg unitaries, less viable as we go along, potentially from the get-go. And that's where I thought it was interesting to look at the more recently created unitaries, and none of them looking particularly great health. So yeah, it's an interesting one. On DSG, is there anyone still on the call? Is the 3 billion, do you think, for those of you who've got DSG up a tier, are you expecting your DSG deficits to increase again, or has the government done anything yet on that? It did talk about £1 billion at one point, but anybody seen anything on that would give you a bit more confidence about your DSG balances? Anybody got any view on that? Unmute. Nothing.
No one wants to talk about DSG balances. It's too depressing.
So Holly said not seen any update on DSG, and Suffolk's will increase. I mean, 40 million it's a bit shocking, isn't it? That's not change. It's significant amounts, particularly if your reserves are coming down as well. Food waste funding. Have you got anything more on food waste funding, Adrian? Extended producer responsibility.
I don't think I have. And Neil asking about extended producer, I guess the producer responsibility grant. I think I think Neil on that on the extended producer grant. My understanding was that you had a one-off guarantee of funding in 25-26. The scheme continues, but in 26-27, you would be the amount of income you'd get will be dependent on how much local producers actually pay over. So the income in theory should continue at a similar sort of level, but you won't have that guarantee, so it could change. That's one reason why we haven't got it in our model, because I think you could say it's a quasi grant in 25-26 because it's guaranteed. But from 26-27, I think it just falls into the category of income. It's just an income stream from that scheme. It doesn't come into the sort of realm of grants, really. I'm not sure whether, DEFRA haven't particularly explained the process very well, but that was my understanding of how it worked. I don't know, Neil, if that's what you were thinking about as well. And the food waste funding, I haven't seen anything on that at all. Again, another thing from DEFRA. They don't seem to realise that it's authorities who are having to do the financial planning here. But I'll take that away and see if I can get any further information on that. But I don't hold out much hope. I think they'll just wait until they tell us. Well, there's quite a lot of comments there about DSG, Dan. I do want to talk about it.
I mean, East Anglia alone, almost 100 million increase. So two authorities out of 150. So maybe the 3 billion increase is 3 billion level is looking like it might get breached in 24-25. So, and that's a shocker. The government has to, because I don't know, Suffolk and Norfolk, those sort of levels are really, really going to eat into your resources, aren't they? And presumably there's a point at which you'll be borrowing against those deficits in order to fund those deficits, because you might have already run out of sort of cash resources. So that's a shocker to me. And those last slides are put on capital and borrowing. Some of the borrowing is capital related, but a lot of it now, I've spoken to a number of authorities that say it's DSG related, because they've got no cash, nowhere to sustain, because DSG deficits, they're unusable, but the cash is out the door. So lots of authorities are turning to short-term borrowing just to prop up DSG deficit positions, which is just not sustainable.
No,
government really has to sort this out, and it has shown a willingness. It sure it mentioned £1 billion, but I'm not. I think somebody's saying they haven't seen anything on that just yet.
I mean, actually, that's probably something we should add to our spending review list as well. Something that we might see some announcement on. Jonathan makes a good point about the EPR funding. That it's a guaranteed level of funding in 25-26. That should indicate the level of actual income you should get in 26-27. But as Jonathan mentions, that producer behaviour should change. So if the policy works, that should reduce the level of plastic packaging, but that also then reduces the level of income that you're going to get from those payments from companies. So, you know, in that sense, it will reduce in value over time as producer behaviour changes. That's the theory. But at least from 26-27, you should start to get a grip on what on what the levels of income look like.
Now Stuart's on the thing today, Adrian. Stuart, do you reckon there'll be exemplifications in the summer for the funding review? Because I keep hearing that they don't intend to put any numbers out as part of the summer consultation, which would be a bit of a shocker, because if you're a 151 and the first time your team sees the numbers is at the settlement in December, that could send shockwaves through, couldn't it? If there's no indication of what the numbers look like when the summer consultation comes out.
Yeah, well, I think that's absolutely right. If I were doing it, it would be a full consultation with detailed numbers for everyone. And I would do it not just because people require notice to set budgets, and not just because they need to know the full implications of the decisions that are being taken, but also because it improves legal security. If you've consulted fully at length about the specific implications, and so the thought that the summer consultation might not have all the details that are required, and frankly, you know, if we're very candid about it, that would be putting the department in a position of withholding information, because, you know, they do have all the numbers. As soon as they have the spending review totals, they can run the formulas, get decisions from ministers, and put material out. So they would be withholding information, just as they did in the December consultation. They published less than they could have done at that time, and that, I think, is quite tricky territory. There's another point which Adrian referred to in passing, when you said that even if all the numbers are published in the summer, the waiting on the consultation is enormous. And I think I would describe it as like wrestling with a balloon filled with water. If you put in so many big issues into the public domain, and you're prepared to make changes, significant changes on some of them in response to the representations you receive, those changes will produce large and unpredictable changes in other aspects, because everything interacts. So if you're prepared to make changes, then it will be very difficult for authorities to predict what their final allocations will be, because they don't know the changes that will be made, and they don't know the effects on the outcome as a whole. So it's not like you've got a choice in consultation, A or B. You've got a hugely complex interactive system. Of course, the alternative is that you make no changes at all, and that is a bit tricky as well, isn't it, to settle?
Yeah, it is.
Yeah,
it is.
Just while I've got the mic, can I come back on another point as well?
Yeah.
Adrian, you mentioned that you thought we would see business rates retention continuing for the foreseeable future, and I think that is correct. Not least because the department will struggle to secure the primary legislation needed to change the system. Getting a bill in Parliament is a very competitive process, and you're up against other bids where people have got significant vote-winning proposals for change, or they're addressing emergencies somewhere else in the system. And so things like this, that, oh, we've sort of gone off this system, it's not such a good idea anymore, let's change it back to what it was before, isn't as compelling as the case that others will make. But having said that, what I think they will do is shift the balance away from incentives and towards needs by having frequent resets, by increasing the alignment with needs within the system, and also reducing the risk that authorities are exposed to as part of the system, which I think they will argue is necessary now that finances are more restricted.
Actually, and also, so on that point, there's one thing that I didn't highlight in the select committee discussion, which made me think about something, was that the minister seemed to be indicating that maybe that they would shift the gains from business rates towards the strategic authorities.
Yes,
and the existing authorities. Oh, sorry.
Yeah,
that is the point.
To carve out a role for strategic authorities in this, both to align with their kind of purpose in life, and also to put their financing on a more sustainable basis. But all of that said, it comes with the significant consolation prize that business rates detention delivers funding, extra money for the system as a whole, which is outside the totals agreed in the spending review. So it's, if you like, free money that accumulates hopefully every year. And that's, if you were to decide to get rid of the system, that's quite a significant loss.
Yeah, and it means to it almost feels like, especially with like the business rate pilots that have been running since 1718, that the Treasury almost doesn't seem to care about them. There was very little loaded onto them at the outset. I was amazed that they've kept on going, but they've just rolled on, and no one seems to report what the values are, what the amount of retention is. They're big numbers, aren't they?
Yeah, I think we stopped calling them pilots. In a very subtle change, we called them areas with enhanced business rates.
That's true. I'm still stuck with the pilots.
Piloting any longer.
It was a misnomer.
They're very difficult to take away once you've given them. So we may well see more of that.
So Stuart, if I put you on the spot and said, will the consultation have extensive exemplifications in or not, what would you say?
Oh, do you know, I genuinely don't know. I've got one set of arguments, which is the hints that people are picking up from a number of different directions. And another set of arguments that says, how could you possibly not do this?
Yeah.
Got to be plan A. In the major consultation on such a large change, you've got to give people a very specific idea of how it will affect them.
Yeah, I'm coming round to.
I hope it does contain. That's the right thing to do in public policy. A significant explanation is required as to why numbers are not included if they're not in there.
Yeah. If I sort of think back to when I was a 151, it would be pretty. We'd be saying that there's going to be 3-year settlement. That brings stability, even if the numbers are a bit grim. At least you know where you are. But all that flies out the window if you don't get that information until pretty much the settlement date, or a couple of weeks before. So, do you think the LGA or groups like that, CIFA, should be pressurising HCLG to really get the exempt? Because I don't know anybody else left from the call, but you would be completely swimming in the dark if there isn't a really, really good indication of what it looked like, and to me that has to be some sort of exemplification.
Yeah, I agree, and you make an important point, which is that the the department's fallen into a rhythm of late and short provisional settlement consultations. That isn't, for new readers on the call, that isn't the way it used to be. It used to be a much longer, more substantive consultation. Having a short consultation carries with it quite a lot of risk. And the kind of prevailing understanding would be that you can't really take away money from people in a short consultation because they have no time to prepare for it and would, reasonably complain about that. So you could only really add money so that there was kind of a no detriment position in short consultation. So your scope for manoeuvre that late in the process is very, very limited. And you can't, of course, extend it further into the spring because you run into the statutory deadline for local authority budget setting. So if the provisional settlement is in late November or even December, as has been stated publicly, the scope for manoeuvre at that point is very limited.
Mm-hmm. Well, one straw in the wind potentially, I think, Stuart, is that Nico seems to be absolutely adamant that the consultation will come out in June, and I would have thought if you're only getting numbers in the spending review 11th of June, to turn those numbers into exemplifications within 2 weeks is there's quite a lot to do, and that he's so sure makes me think it's a pre-written narrative consultation.
Yeah, well, you may well be right. And certainly a normal quality assurance process for the numbers would itself take about 2 weeks, even leaving aside the time required for ministers across departments to agree. Because the alternative to that is that the numbers are actually agreed already. That they not last minute. I mean, they often are last minute. Ministers like to engage in brinksmanship and take it right up to the day before they finally reach a deal. But it's not impossible for it to be agreed sometime in advance and the policy process to be complete.
So they may already have stuff ready to go.
Yeah, but I feel I'm sort of clutching at straws here.
Yeah, it is.
We will see shortly, won't we?
Yeah. Martin reminds us that the 3-year provisional settlement came out on the 26th of November 2008, mere weeks after Lehman Brothers collapsed. That was a mere pimple, Martin, compared to the consultations we've got to deal with this time around. And LGR, that's a complicated factor. LGR, at what point do they actually set that these are the authorities that are actually going to be in the settlement, in the 3-year settlement? That's another thing. Just want to say anything that there was. Just going back, there's quite a few comments there, Dan, about pools. And I think pools will still be open to authorities, but it doesn't feel like it's going to be. It's just going to be harder, isn't it? Less viable. Not sure. Yeah. Martin, another point there about this disconnecting responsibility from authorities for charitable and anti-property relief by paying everything by Section 31 grants. I think that's probably true. You'll be less bothered by it, but I'm not sure how much control people have had over it in the scheme anyway. So yeah, but I take your point. I agree with it really.
I know when I've worked at districts, there's been quite a backlash from business folk in towns around charitable occupation and whether charities are really entirely charitable and they're not competing sometimes. So again, that sort of thing might not be great, might it not, if there is no control over that.
Yeah,
it's just taken as read. So it's a good point.
Yeah, and actually Nick also making the point about the really big issues not in the business rate consultation, that could be a big consequence for the future. I think that's absolutely right. I mean, particularly tier split drops for districts. They've got it's a very different scheme for districts in the future. If they're, if their tier split drops from 40 to say 15% or something like that, that's a very different scheme for districts in the future.
Yeah.
But let's see. Yeah. Great stuff, Dan. Are we kind of there, do you think?
I think so. It's
Yeah.
Everyone's going on to their next meeting, so
yeah, I'll get the
really
recording done as fast as. I'm away for a couple of weeks, last 2 weeks in May. So I'll see you all when afterwards when I get back, and we'll have the next webinar will be after the spending review. So 12th or 13th of June, Dan and I would be here looking at that. Great stuff, Dan. Thank you very much. Stuart, thank you for your comments there. Very much appreciated. Thank you very much for that. It's really insightful. Thank you. That's great.
Bye.
Good luck with the accounts, everyone. Good luck with the accounts.
Thanks, everybody. Thanks. Bye now.
Cheers.
Bye-bye.
Bye.